But you do get this feeling, when you're a jobber. I mean, I've known jobbers, which is really what they do. I mean, the market maker is a jobber, basically. I've known these guys. I've been on the other side of them since 1970. And they do have this sense, if you like, in the market, when it's right to bash the price of something which they're short of. It's almost like a second sense. And if they haven't got it, they're not going to survive terribly long in whatever they're dealing in. So if one good dealer has got the feeling this is the moment when it's going to come off, the others also have the same feeling. So, you get this sort of compounding effect. And of course, I think what the buyers are doing in this, and remember, we're not talking retail market here. We're talking about wholesale market, and we're talking about big derivatives. The buyers, I think, they would just sit on their hands. And
gold, silver, and platinum prices took a sharp drop. It surprised many dealers. Nearly 5% gold plummeted. As silver fell 7%, platinum group metals fell almost as much. Casual viewers might think the precious metals bull run has stopped. Instead of a market losing conviction, this sudden decline appears to be a premeditated shakedown. Alasdair Macleod's new interview cuts through the noise. We may not be seeing weakness, but deliberate positioning by the same powerful institutions that have traditionally dominated the metals market. Bullion banks and large derivative players have instinctively acted together when gold and silver rallied too quickly. When mood is bullish, as it was lately, even establishment figures like J.P. Morgan's Jamie Dimon. Consider gold reaching $5,000, $10,000, and Morgan Stanley encouraging customers to devote 20% of their portfolios to gold. Banks trading on the opposing side of those bets frequently restore equilibrium rapidly. Volatility flushes out speculative longs, narrows exposures, and resets the price floor. However, if this is a concerted shakeout, precious metals' upward momentum may be too great to ignore. Data from futures markets supports this. In contrast to excessive speculation, Comp's gold open interest is less than half its long-term average. Demonstrating structural demand has fueled this advance. Outside the West, central banks are accumulating at record levels. After years of paper gold manipulation, retail investors have switched to physical holdings, and huge hedge funds, many of which missed the early boom, are now positioning themselves more long. Thus, the market is strengthening. These dynamics suggest a volatile month ahead. All attempts to restrict gold and silver prices in the past decade have ended in stronger rises. As inflation persists, government debt rises, and global trade shifts toward commodities and physical assets, precious metals provide asymmetric protection that few other investments can match. The story may not be the price drop, but what happens after consolidation. Alasdair Macleod discusses the mechanics of the current correction and the wider geopolitical developments affecting it. He discusses how China's covert creation of a gold-linked trade network could foreshadow a new Bretton Woods moment where gold again anchors global commerce. He describes how global South Central banks are preparing for post-Doll monetary order. Subscribe and like this video if you enjoy my analysis, so more investors may find in-depth talks like these. Thanks, and let's start.
How much gold and silver and indeed platinum group metals have soared in recent months. Some sort of correction was definitely on the cards. But the interesting thing is that the whole thing has really been a short squeeze. If you look on COMEX in particular, the speculators are just not there. I mean, they haven't really bought into it. The way I would measure that interest is looking at open interest. An open interest in gold is less than half the long-term average. Open interest in silver is roughly at the long-term average. I mean, there are obviously a few speculators in there, hedge funds, whatever, but not all that many. So this shakeout, it looks sort of suspiciously coordinated. I don't mean that over the weekend, various bullion banks got together and had a meeting and decided to bash the market. But you do get this feeling, when you're a jobber. I mean, I've known jobbers, which is really what they do. I mean, the market maker is a jobber, basically. I've known these guys. I've been on the other side of them since 1970. And they do have this sense, if you like, in the market when it's right to bash the price of something which they're short of. It's almost like a second sense. And if they haven't got it, they're not going to survive terribly long in whatever they're dealing in. So if one good dealer has got the feeling this is the moment when it's going to come off, the others also have the same feeling. So you get this sort of compounding effect. And of course, I think what the buyers are doing in this, and remember, we're not talking retail market here. We're talking about wholesale market, and we're talking about big derivatives. The buyers, I think, they would just sit on their hands and watch this play out a bit before they decide, shall we buy some? And if so, what's a level? And so on and so forth. So, this is why I think this shakeout has been so severe. I mean, I'm looking at what's happened in silver. I mean, silver is down nearly 7%. Platinum's down 5.7%. Palladium down 5.3%. And gold, as you said earlier, is 5%. I mean, given the rise that we've seen, this isn't actually all that great. I mean, you would just say this is volatility, if you like it.
Yeah.
Because the guys on the other end are so powerful. They'll take every cent you've got off you if you're going to trade it. And, the answer basically is that you've got to work out why you're interested in gold and silver. You've got to understand what gold and silver are. I mean, particularly gold in the current context, what it is. You've got to understand that it is legal money without counterparty risk. Forget what the US Treasury says about gold being a pet rock or whatever. The reality is that in our common law and in everyone's common law, gold is money, it's final settlement, there is no counterparty risk. And the volatility isn't so much in gold. I mean, obviously there's been volatility in gold, but it's mainly in the currencies. So when you see, for example, the People's Bank of China buying gold, the way to look at it is actually they're selling dollars. And they have other use for those funds. But basically they don't want dollars. So that's, if you like, the sort of their gold purchases are almost the small change, which they haven't got any other use for because they've got quite enough gold. I mean, not necessarily within their reserves, but the nation has lots of gold spread around various accounts, including the People's Liberation Army, the Communist Youth Wing, and so on and so on and so on. So that's the way to look at it. So you've got to think, okay, do I buy gold because I think that paper currencies are going to lose purchasing power? If you think that, then the answer is yes, and you hold it, you hoard it, you tuck it away. Otherwise, don't mess with it. Forget it. It's a waste. You'll just have sleepless nights if you try and trade it, because I can tell you, you try and trade this market, they will take you for every cent you've got. That's the reality of it.
Beginning with perspective, Alasdair Macleod's analysis is at its core. He emphasizes that in markets that have escalated beyond their capacity, abrupt corrections are not only common, but frequently indispensable. Silver's and gold's headline-grabbing 7% and 5% declines diminish in comparison to the gains these metals have achieved in recent months. The current dip is not a breakdown, but rather a rebalancing, as indicated by the scope of the move and the limited speculative participation present. The precise method of selling is what distinguishes this episode. This possesses the characteristic of experienced market makers who possess a superior understanding of sentiment and timing than any other individual in the industry. Retail speculators frequently end up as victims in this environment, while long-term holders tend to emerge as the more resilient group. The guidance provided by Macleod has been consistent. Do not engage in the trading of gold and silver. Please comprehend the rationale behind your ownership. They are monetary anchors, which are legal money that is not subject to counterparty risk. They are not speculative vehicles. He observes that the volatility is not inherent in gold, but rather in the currencies that are employed to set its price. When China sells dollars to accumulate gold, it is not in pursuit of returns. Defensive purchasing power is the objective. The quiet strategy of accumulation is beginning to appear more prescient as the world's monetary system becomes more precarious.
Yeah, I think there's another point which is worth making. We've seen various large American banks, turning bullish on gold. I mean, Jamie Dimon said he wouldn't be surprised if it went between 5,000 and 10,000. You had Morgan Stanley saying, you should put 20% of your portfolio into gold, which actually is an extraordinary statement from an establishment bank like that. I could imagine that Scott Bessent would sort of phone him up and say, "Why are you messing up my world?" But so they've turned bullish, and from the point of view of market makers, the bullion banks who are trading, if you like, on the right side of the quote, this is not helpful to them at all to have this. So this is why, if someone told me that there was a coordinated move to basically bash gold and silver and also platinum group metals lower, I could believe it. I really could, because what they would want, it's not that they're anti-gold or silver, it's just they want to get their position square. And I think this is a desperate attempt to just do that. Let's try and, get our bears closed a bit, and then at least, we can trade it at a higher level. I think that's all. That's what's going on, if you like, in London and New York. Staying, if you like, with the market rather than the logic of buying or holding or hoarding gold or silver. You're absolutely right that you've got these logistical problems. I think the other thing which we will discover is whether on higher prices the shortage gets resolved. I suspect that people who have hoarded silver, I mean, let's just talk silver for the moment. It's true of gold as well. A slightly different situation. But people who have hoarded silver are either in two categories. They're either industrial users, and they're not going to sell their physical into the market, or they are investors. Now, there are various estimates out there as to how much silver is being held by investors. I've heard numbers of sort of 2 billion, 3 billion ounces. I don't know. I don't think it's nearly as much as that. I think all you can do is look at the stocks in COMEX and look at the stocks in London, and perhaps pencil in a figure for something in Switzerland. The rest of it, I think, we'd rather ignore, because the idea that you've got these investors, if you like, in places like China and all the rest of it, are likely to sell their stuff. I mean, if they sell it, it would probably, circulate within the country rather than come onto the general market. I think that these people are increasingly concerned that if they do sell their silver, they're not going to get it back. And the reason I think that they are feeling that is that if you have hoarded silver, or indeed gold, and to a lesser extent platinum group metals, you are obviously taking a view that the purchasing power of the dollar or your own currency is declining. And we have seen enough evidence, I think, that this is now happening, perhaps at an accelerating rate. I mean, you don't need to be a sort of wonderful economist. You just have to have a look at, what Trump's doing, and you sort of think, this is capricious, it's destabilizing, the whole thing. You see the geopolitical situation and so on and so forth. I think the answer is you hang on to your silver. I think that's what people will do. And I think that's what has really resulted in the squeeze in the market. I mean, if you look at the stocks, in the vaults in the LBMA, I can't remember exactly what the figures are, but people try and make a guess about liquidity, and it's pretty minor. It really is. And of course, not only have you got the whole world, the retail world, I mean, all around the world. The story you were telling, I heard from Australia this morning. I've heard also in America, UK, everywhere.
Everywhere, yeah.
Everywhere. Everybody's run out of silver and gold coin and bars. The Perth Mint has stopped. It's got no silver, no gold, and so on. So this is a global story, if you like. And under those circumstances, you sort of think, well, if I am going to sell my silver, do I sell it while there is a shortage? I think I'd probably ride it out a bit more. That is if you're even trading it. If, on the other hand, you're a hoarder and you're sort of looking at what's going on in the world and all the rest of it, then you probably think, well, wasn't I clever buying it? I'm just going to sit on it. So You have this situation where there's something called a Giffen good. The more it rises, the more demand it creates, and the lower the supply becomes. In other words, it's a complete reverse, if you like, of market theory that rising prices will, release more product. Now, having said that, I mean, you've also got other factors coming in. I mean, there is no doubt that the mines are becoming very profitable on these prices. You must be coining it in, and if it goes up further, even more so. But what does a mine manager do? And I think this is a point which many of the sort of commentators don't really understand. A mine manager's job basically is to maximize his cash flow in the context of the business he's running. So when he sees the price rise, what he does is he mines the lower grades. So does this lead to more supply? Not really. And the other thing is that I think over 50% of silver mine supply comes out as a byproduct of the mining of other metals. So, that's something. Scrap takes a bit of time to, it doesn't take terribly long to turn it, but it's a question of refining capacity. And at the moment, refiners, they're not really interested in taking in silver because they're so busy with gold. So, there are a number of factors which I think lead to the squeeze. And, anybody who owns silver, I think, when they reflect upon it, they sort of think, well, wasn't I right to buy it? And I think that's the way it is. And with gold, there's something interesting there too, because we don't have the backwardations between the spot and the futures market. Seems to be quite normal. I think that the bullion banks are trading that reasonably successfully. I think they probably welcome the uptick in business. They will be losing a bit on their positions on a mark-to-market.
In concluding his analysis, Alasdair Macleod situates the current precious metals market within a more comprehensive historical and economic framework. Drawing on his research on post-World War I Germany, he elucidates the predictable patterns that inflationary cycles and credit crises exhibit. At first, there is a period of adjustment and devaluation. Finally, the currency collapsed catastrophically. With over $1.2 trillion in margin loans supporting equity markets and trillions more in leveraged assets throughout the financial system, following a deceptive period of apparent stability and prosperity. A safeguard against systemic failure, precious metals are not an investment bet in this scenario. Gold's function, as Macleod underscores, is not to increase in value for the sake of profit, but rather to stabilize value during the unraveling of paper assets. It is the same logic that applies to silver and platinum, which maintain their intrinsic monetary characteristics despite being industrially driven. Because of their permanence in a world of vanishing promises, these metals become the natural refuge of capital when currencies falter and confidence in central bank policy dissipates, rather than due to speculative fervor. He also raises questions about the contemporary fascination with digital substitutes such as Bitcoin, comparing its emergence to the tulip frenzy of the 17th century, a speculative phenomenon that was not governed by monetary law or stability. The world will rediscover the significance of lawful money and tangible settlement when the credit bubble collapses. Nor will governments relinquish control. Rather, they will strengthen it. Gold will once again assert its legal and historical status as the ultimate form of settlement in that environment. According to Macleod, the forthcoming phase will distinguish those who comprehend monetary history from those who confuse volatility for failure. The lesson for investors who are committed to the long term is evident. Although the path ahead may be tumultuous, the intrinsic direction remains unaltered. Prices are currently being suppressed by the same forces that will ensure higher valuations in the future. As the dollar weakens and global liquidity fragments, the demand for physical gold, particularly in the East, will only increase. This is not the conclusion of the precious metals bull market. This is a critical juncture, requiring strategic perseverance and disciplined accumulation as it is in the consolidation phase. If you found this discussion to be insightful, please consider liking the video, sharing it with your fellow investors, and subscribing to receive additional in-depth analyses from expert analysts in the precious metals sector. Please accept my gratitude for your attention.